Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome back to our weekly podcast, Through the Noise. My name is Hannah Chiu, Portfolio Strategist with the Standard Chartered CIO Office, and I will be your host for today. So joining me today is Raymond Cheng, our North Asia Chief Investment Officer, to help unpack market events and talk about positioning and where opportunities might lie next. So Raymond, thank you so much for joining us today. We are going to jump straight into it. So the Middle East conflict that seems to have reached a stalemate. So what does that mean for the markets?
Hi, Hannah. The Middle East conflict appears stuck in a prolonged stalemate, with neither the US nor Iran willing to soften its stance, keeping geopolitical risk elevated in our view. The energy prices should remain volatile, though oil returning to March-April levels seems unlikely, which should help inflation. However, European gas prices remain near early conflict highs, with potential implications for Eurozone monetary policy.
Thanks, Raymond. And I guess another important data point that came out, this week is really on the U.S. inflation and employment data, right? So the July data, it seems to have pointed to further moderation and inflation continuing to cool. So what are the implications of these data?
That's right. Employment data does point to further moderation in aggregate activity in the US, with the exception of AI capex, which shows no sign of slowdown. The US July headline CPI inflation print slowed to 3.4% year over year, while core inflation declined to 2.5%, its lowest level since year 2021. Producer price index also decelerated to 4.7% year over year. Meanwhile, non-farm payrolls unexpectedly contracted by 23,000, and employment gains for May and June were revised down as well. These figures altogether suggest the strong momentum in job growth seen during the spring has faded. The combination of softer inflation and weaker hiring gives the Federal Reserve greater flexibility to remain patient. Policymakers will still feel more residual pressure to hike, as inflation has been above target for several years now. But the direction of travel suggests such pressures are easing. Now, our base case remains that the Fed will keep rates on hold through year end. This backdrop should limit upward pressure on US government bond yields at the short to intermediate end of the curve. Although the uncertain US fiscal outlook could keep long end yields elevated. The 30-year Treasury bond auction on August 13th priced the long bonds at the highest yield level ever seen since year 2007, reflecting investor concerns about US fiscal policies.
Okay, so what we're hearing is that we think that the Fed is likely to keep rates unchanged through the year. But what about the European Central Bank and the Bank of Japan?
While the Fed is likely to keep rates on hold through year end in our view, the ECB and the BOJ are more likely to face pressure to tighten. The ECB faces a difficult trade-off as natural gas prices in Europe remain close to the highs reached during the initial outbreak of the US-Iran conflict, increasing the risk that energy costs feed into headline inflation and inflation expectations in Europe. As an inflation targeting central bank, the ECB may feel compelled to tighten policy once more, even as regional growth remains fragile. As a result, we expect one more rate hike from the ECB before end of this year. Now, the BOJ also remains under pressure. Negative real yields and the still wide interest rate differential between Japan and the US continue to weigh on the yen, despite earlier coordinated intervention by the two countries. A currency weakness could raise imported inflation and undermine the durability of intervention unless it's supported by quicker monetary policy normalization. We therefore expect the BOJ to deliver one additional rate hike before end of this year.
All right, thanks, Raymond. So maybe let's shift into the equity space. So we've seen, equities they stayed pretty resilient this year despite the geopolitical and the macro uncertainty. So what's really, keeping the US equity supported?
Hmm. U.S. equities remain supported by a favorable combination of macro and corporate data. Now, on the macro front, we see bond yields moderating because of softening inflation. And on the corporate front, we're seeing Q2 earnings remaining quite resilient. The softer economic data have reduced pressure on yields, while earnings results from corporates continue to demonstrate profitability at a healthy level. This has allowed US equities to generate positive returns despite persistent geopolitical uncertainty that could create volatility in the near term.
Ah, okay. So how about, China equities? Any implications that we're seeing from the rising enthusiasm around China's technology IPOs?
Yeah, we continue to stay constructive long term on China tech, in particular tech equities in China, which are supported, in our view, by China's policies that promote innovation, supply chain localization, and self sufficiency. A strong demand for some of the recent China tech IPOs signal a structural re-rating around China AI names. New listings are likely to broaden participation and direct capital towards China semiconductors, robotics, and AI, among others. This keeps us overweight on China tech equities. Now, we have an opportunistic idea on the Hang Seng Technology Index. While rising AI investment is weighing on sentiment across some internet platforms, AI should fuel monetization across existing and emerging businesses. Strong cash generation from core operations can help fund these initiatives. The June inclusion of pure play AI model companies in Hang Seng Tech marks a structural change that could increase the index exposure to the AI theme. The planned expansion of the technology index from 30 stock constituents to 50 in the future should also make the index more forward looking and help capture high growth technology companies' early gains. Now, along with discounted stock valuations, earnings, and IPO momentum, these changes are expected to support a recovery in the second half of the year for the Hang Seng Technology Index.
All right, thanks, Raymond. And maybe now we'll just shift and look into bonds. So we also see that the US high yield spreads, those are near historically tight levels. So what really constitutes a fair value for high yield spreads, and what might be the investment case for high yield bonds?
Now, while U.S. high yield credit spreads currently at around 266 basis points are near the tightest levels and in the fourth percentile over the last 15 years. The asset class does not look expensive from a yield perspective. The U.S. high yield currently yields around 7.26%, placing it at the 69th percentile over the past 15 years. In addition, the U.S. high yield default rate is currently at around 2%, below the long term average of 3 to 3.5%. And that's likely because of the increased mix of BB rated credit in the index, which approaches 60%, and is also supported by a resilient U.S. economy. The US high yield credit metrics are stable and are projected to improve into year 2027. The maturity wall has also been pushed out to 2028 to 29 as significant refinancing was completed in 2025 and early this year, taking advantage of favorable market conditions. There's also a lack of large issuances from hyperscalers in the US high yield space that could otherwise weaken market technicals as well.
All right, and maybe just a final question from me. But what's the outlook for the Aussie dollar given the latest RBA decisions, and any chance there are any correlations to gold that we should take note of?
Now, the RBA's hawkish pause of late is important for our view on the Aussie dollar. With inflation remaining quite elevated in Australia, the RBA sees upside risks to inflation. Governor Bullock reiterated that rates could rise further if required. A softer US dollar, improving China growth momentum, and supportive commodity conditions provide additional support for our constructive view on the Aussie dollar. And hence, the 0.74 and 0.75 forecast for the Aussie dollar against the US dollar 3 months and 12 months out, respectively. As for gold, we have gathered some data from Bloomberg, which shows that the gold Aussie dollar correlation stands at around positive 0.82 over the recent 3 months, notably above the positive 0.59 3-year correlation level. Now, the 0.23-point gap shows that gold and the Aussie dollar have moved much more closely together recently, as both have benefited from similar macro tailwinds. However, our view is that the more moderate long-term relationship suggests gold remains a secondary indicator for the Aussie dollar as opposed to being a primary driver.
Thank you, Raymond, for all your insights. I think that's a lot of it to digest and to rethink through. But in today's session, we have discussed, how investors can sort of navigate the geopolitical tensions in the Middle East against a backdrop of, changing macro conditions. We've also highlighted a couple of tactical opportunities in the current market environment, including areas where investors may consider to add exposure into. So that brings us to the end of today's episode of Through the Noise. Thank you again, Raymond, for joining us, and thank you to all our listeners for joining in as well. We look forward to having you with us again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.